Hello and welcome back to Explain the Charts. Today is October 10th, 2025, and we are taking a deep dive into the Nasdaq 100 ETF, QQQ. The market is at a critical juncture, pushing to new all-time highs just this week, yet there's a tangible sense of unease with yesterday's pullback and a slew of concerning economic headlines. Is the market getting ready to break higher, or is this the top before a significant correction? First, we'll break down the major news events driving the sentiment, and then we'll jump into the charts to see what the price is telling us. The current news landscape is a mix of powerful bullish and bearish signals. On the positive side, the artificial intelligence narrative remains incredibly strong, recently supercharged by a mega deal between AMD and OpenAI, which sent semiconductor stocks soaring. Adding to the bullish fuel, the Federal Reserve continues to signal more interest rate cuts are likely this year, a huge tailwind for growth-oriented tech stocks. However, storm clouds are gathering on the horizon. The U.S. government shutdown has now entered its 9th day, creating uncertainty and threatening to disrupt the economy. We're also seeing signs of a softening labor market, which, while potentially prompting the Fed to act faster, also points to underlying economic weakness. Some corporate earnings have been fantastic, with companies like Delta and Costco showing consumer resilience. Conversely, others like Ferrari have issued downbeat guidance, and tech giants have flagged rising AI-related costs, which could squeeze margins. Most notably, JP Morgan's CEO Jamie Dimon has voiced significant worry, assigning a 30% probability to a serious correction in the near future. So we have a classic battle, a dovish Fed and a powerful tech narrative versus mounting macroeconomic and political risks. Now, let's turn to the daily chart for QQQ to see this story unfold in the price action. The long-term picture is undeniably bullish. For the last year and a half, the price has carved out a clear and powerful uptrend, consistently making higher highs and higher lows. The momentum, particularly since the spring, has been relentless, with pullbacks being shallow and quickly bought up by eager investors. This week, we punched through to new all-time highs above the $610 mark, which is a significant psychological achievement. It shows that despite the negative headlines, buyers are still in control of the long-term trend. The key question now is whether this breakout has the strength to continue. To understand the current market's resilience, let's zoom in on a period mentioned in the news articles, the April meltdowns. Here on the chart, you can see a dramatic, high-volume waterfall decline in early April, where QQQ plunged from around $480 all the way down to nearly $400 in just a few sessions. This was a moment of significant fear in the market. But what happened next is the most important part of the story. Look at this massive bullish reversal candle on April 9th on even higher volume. This was an aggressive V-shaped recovery. This event established a powerful precedent for dip buying, signaling to the market that institutional players were waiting to buy any significant sign of weakness. This psychology has defined the market's behavior ever since. Bringing our focus back to the current action, let's look at the price movement since August. After hitting a peak around $580, the market entered a period of healthy consolidation, pulling back and finding solid support in the $560 to $565 zone. Following that, we saw a powerful, high-volume breakout in mid-September that launched us toward the $600 level. The market then briefly paused, pulling back to establish support around the $590 to $595 area before making the final push to the record highs we see today. This price structure is technically very constructive. It shows that old resistance is becoming new support, a classic sign of a healthy uptrend. To get an even closer look at this week's breakout and subsequent pullback, let's switch to the 15-minute chart. Here we can see the strong, steady climb throughout the day on October 8th, which ultimately set that new all-time high just above $611. Now, look at yesterday, October 9th. We see the market opened high but immediately faced selling pressure, dropping to establish an intraday low around the $607.50 mark. However, buyers stepped in to defend that level, and the market spent the rest of the day grinding its way back up, closing well off the lows. This intraday action confirms the news reports of a pullback, but also reinforces the theme of dip buyers providing a floor under the market, at least for now. So, let's define the most important price levels to watch right now. Because we are at all-time highs, there is no historical price resistance above us. This means resistance levels are purely psychological. We should be watching for reactions at round numbers like $615, $620, and $625. On the downside, support is much clearer. The most immediate, minor support is yesterday's low around $607. A more significant level is the major psychological barrier at $600. However, the most critical support zone to watch is the area of the late September consolidation, from roughly $590 to $595. This is the line in the sand for the current bullish leg. Let's outline the bullish case from here. The argument is straightforward. The primary trend is up, and you should not fight the trend. The market has consistently rewarded those who buy the dips. Fundamentally, the prospect of more Fed rate cuts provides a massive tailwind for the high-growth technology companies that dominate the Nasdaq. The AI revolution is still in its early innings and continues to attract enormous investment, acting as a powerful thematic driver for the entire index. As long as price holds above the critical $590 to $600 support zone, the path of least resistance remains to the upside. A clean break and hold above $612 would signal a continuation of the breakout. Now for the bearish case, which should not be ignored given the context. The market has had a tremendous run and is technically overbought by some measures, making it vulnerable to a pullback. The government shutdown is a significant wildcard. The longer it drags on, the more economic damage it could cause, potentially souring investor sentiment rapidly. Jamie Dimon's warning is a reminder that smart money is becoming cautious at these levels. A clear sign of weakness would be a failure to hold the $607 level, followed by a decisive break below the psychological $600 mark. If sellers manage to push the price below the critical $590 support, it would signal a major shift in character for the market and could trigger a much deeper correction toward the August lows around $560. So, to summarize everything, here's what to look for. Your key support levels are $607, $600, and the critical zone at $590. Psychological resistance lies at $615 and $620. My primary expectation, which I'd place at a 65% probability, is for the market to consolidate in a range between roughly $600 and $612. This would allow the market to digest recent gains before potentially making another attempt higher, supported by the strong underlying trend and Fed optimism. For this scenario to play out, we need to see the shutdown resolved without major economic fallout. A lower probability scenario, at around 35%, is that the macroeconomic fears take hold, leading to a break of $600 and a serious test of the $590 support level. How the market reacts at $590 would be incredibly telling. A strong bounce would reinforce the bull case, while a failure there would be a major red flag. Watch for any surprise inflation data or hawkish comments from Fed officials, as that could quickly shift the odds. That's our breakdown of QQQ for today. Keep a close eye on those key levels and the evolving news landscape. Thank you for watching Explain the Charts. Please remember, this content is for informational and educational purposes only and should not be considered financial advice. Always conduct your own thorough research and consult with a qualified financial advisor before making any investment decisions.